That's right. After 2 years of negative readings, the Bureau of Labor Statistics, the BLS, as you know them in your hood, they reported a 0.2% increase in real hourly earnings. This gauge shows us that consumers are finally getting ahead of inflation. This, coupled with the resilient labor market, could help maintain consumer demand. We have Yahoo Finance senior columnist Rick Newman with us, who just slid into the chat.
Yeah, I came down. I beamed in.
I like that.
Cool. New technology we have here.
Yeah, that's the next wave after AI. It's transporting.
So help us break this down, Rick.
The most overlooked news of the week,
Yeah.
0.2% increase in real earnings. Did you guys feel it in your paycheck? I mean, did you notice that your paycheck swelled? No, you didn't. I mean, it sounds like nothing, 0.2%, and no ordinary people are going to notice that. But it's an important change in the trend because we've had negative real earnings for the last 2 years. That's because of inflation. Real earnings are pay income when you adjust it for inflation, and that's been negative for the last 2 years, which means people have been falling behind relative to inflation. And I think that helps explain why consumer confidence is at recessionary levels, basically. Even though we have a strong job market and people are spending money, they just feel crappy. And President Biden cannot get his approval rating out of the low 40% range, and I think this is why, because people have been falling behind and they feel it. So we are finally getting a turnaround now. I think it's going to take months of this sustained for people to feel like it actually is helping them get ahead, but we're getting started.
If the Fed doesn't stomp it out.
Well, of course, but I mean, this is the weird swirl of all this economic data. So, this is secondary to the Fed, but they want to see positive, real income, and their part of that is get inflation down.
Right.
But
that includes wage inflation.
That's right. I know. So,
as they say, it's a blunt instrument.
Right. So, what's the Fed? Will the Fed put out the party? Who knows? I mean, we've been talking about this recession that's supposedly imminent for about a year and a half, and it still isn't here, and it still isn't imminent. So let's just let consumers start to feel a little bit better and stop beating them over the head with the recession that is going to arrive someday.
Well, we are all consumers too, and we would like to all feel a lot better. It is Friday, by the way.
I think it's okay to feel
It's okay. It's all right.
That's my message today.
Well, let's bring you back in, Brian and Ben, on this, because consumers are remaining resilient, but this hasn't eased recession concerns. And the Deutsche Bank chief researchers, they put the possibility of a U.S. recession coming as soon as October near 100%.
Boo!
So, yes, boo them. They're taking away our good.
I'm not buying it. I'm not buying 100. Come on, 100%?
Yeah.
I've looked back at all the recession predictions.
Yeah.
We've literally been hearing this for a year and a half. It seems imminent, and it keeps seeming imminent 6 months down the road.
Well, the funny thing about all of this is, if you were feeling, conspiratorial, you could say, well, this is a conspiracy to get people to slow down their spending. But even if that was the case, it ain't working, right? I mean, so I guess all of this also speaks to the Fed's transmission mechanism and whether it is going to be successful at getting inflation down.
Yeah, well, you got to remember, too, when the Fed makes a move, it's 6 to 9 months before it really flows through to the economy. So we have a lot of hikes still to flow through that haven't really impacted us yet. But there's no doubt the consumer is willing to spend. They're willing to run up the credit card, continue to see those levels increase. And, I don't think there's anything that's going to slow them down until they feel uncomfortable with their employment situation, right? If you're worried that you may not have a job tomorrow, that's when you start to cut back. But that could be 6 months, 9 months, 12 months. I'm very confident that a recession's coming. The inverted yield curve pretty much tells you that.
Timing is everything, though.
But timing is everything. The timing is extremely challenging. You never know what the event is that kind of tips. And I would say with the liquidity that's being pulled out of the system, and now, of course, the Treasury bulking back up their balance sheet, pulling more liquidity out of the system, it's not evident until it is evident.
One thing we know is going to happen, though, which is that the excess savings that everybody accumulated during COVID, that is going to run out. So estimates are there's still about $500 billion of money in people's bank accounts that they saved above what they would have saved otherwise during COVID, because no one could go out, no one could spend the money. So one of the things that's been keeping spending solid is people have that excess savings. That is going to run out probably by the end of this year. And so as a cushion, as a spending cushion, that'll be gone. And then that gets to the question, are people going to feel confident enough to run up credit cards, or are they going to say the spree is over?
And I think a huge item that people are not paying a ton of attention to is the student loan moratorium.
Yeah.
They got to start paying again in September. And I have a feeling the people that have to pay, they weren't putting that money in the bank in the savings account. So that's going to take a hit. And then we may get a double whammy. We'll have to see the Supreme Court ruling sometime before the end of June whether there's going to be loan forgiveness there as well.
Rochelle, hit us with the Beltway barometer. I mean, what are the consumers like down there in the DMV?
DC consumers never stop shopping. I just feel like we never stop. I think DC is one of the places where you just don't see that showing up as much. But for people who are wondering in terms of fixed income, when they're taking a look at what's happening with the bond market there, Brian, where are the opportunities then for people who are wondering how long this rally is going to continue in fixed income?
Well, the easy money is just in short-term fixed income. You can hang out there with very little to no risk and clip 5.5%. Maybe even a little bit more than that, depending on your choice of product. What I think for the long term, we got very aggressive buying long-term bonds back in October, around 4.25. I believe the Fed is going to hit in the long term their 2% inflation target. So if I see long-term rates get back above 4, around 4.25, to me that is a great long-term buy because that is a good long-term real return in my opinion.
Ben, I'm going to ask you to, and then we got to leave it, but you get last word on this. What do you think on that front?
Yeah, there is a total return opportunities, we would say then. Like, meaning, if the Fed succeeds with that policy to get inflation towards 2%, then long-term bond yields will go towards where the Fed thinks the long-run rate is 2.5%. So think about it, if you just said, Brian, like 4.25, from 4.25 to 2.5 on, say, a 30-year bond, well, that's almost 25% total return. That's, I think, the opportunity, but it will take some time to get there. So because if real spending continues to improve, real incomes continue to improve, productivity continues to improve, it may take some time to get to that sort of outcome. But it does look like that the bond market is giving the Fed a lot of credibility because there is some risk measures on bonds that we call that term premium. Ironically, that's a negative currently, whereas bond yields are higher, and that difference tells you that the bond market, one, doesn't see surprise from the Fed, believes the Fed is going to hit its inflation target, but also believes that inflation probably really is towards the direction of 2%.
We'll find out.
Yeah.
All right. Thanks, guys, for being here. Really appreciate it. Ben Emons of NewEdge and Brian Rehling of Wells Fargo. Really appreciate you spending a little time with us on this Friday morning. Have a great weekend, guys.
Thanks.